Chapter 10, we discussed long-term liabilities. Primarily, we discussed bonds, bond payable, and also we talked about installment notes. And then in Chapter 11, we discussed the corporate form of organization and some of the transactions that are specific to that form of organization. Problem one here is dealing with bond and bond interest. So let's take a look at what's happening. We're talking about Brigham Company issuing bonds with a par value of $800,000 on their stated issue date. Bonds mature in 10 years and pay 6% annual interest and semi-annual payments. Remember, when we're calculating interest on this, we either need to divide that interest rate in half because it's paying twice per year, or we could use this interest rate and double this number, the 10 to 20, to make it basically double the time. So on the issue date, annual market rate for the bonds is 8%. Let's think about that for a second. If our bonds are paying 6%, but the market is paying 8%, then they can go to the bank and make more interest. So what could we do to compel them to buy our bonds? And obviously that means that we would sell these bonds at a discount. So number one here is what is the amount of each semi-annual interest payment for these bonds? A few things they want us to do. How many semi-annual payments will be made? Use the interest rates given to select whether they're issued at a discount or a premium we just discussed. Compute the price of the bonds as of their issue date and prepare the journal entry to record the bonds issuance. All five of these things are going to happen under these five requirement pieces. So here we are on 1 through 3. They're asking us to figure out what the semi-annual cash interest payment is. So simply we're going to take the par value at maturity, and if we look up here real quick, it was $800,000. The semi-annual rate would be half of the 6%, and that will help us calculate the interest. So $800,000, and we're going to run that at 3%. And that will give us a semi-annual cash interest payment of $24,000. Roll down here to the number of payments. Again, we were at 10 years to pay semi-annually. So if we double, looks like we're going to have issues with Connect already. If we double that, it will be 20 payments. And we've already discussed that we are going to be at a discount. Okay. Let's go on over to requirement 4. So this is asking us to compute the price of the bonds as of their issue date. As we had discussed in class, we have to use the present value tables for a present value of a lump sum and the present value of an annuity. We have to figure out the present value on the cash flows of the bond. Remember, a bond is going to pay one lump sum at one future date, and then it's going to make equal periodic payments of interest over the life of the bond. So when we do that, there are a few things that we need. One, we need to figure out what the number of periods are. Well, we just did that. It's 20 periods. But when we're computing the present value, we need to look at the interest rate based on the market rate. So scroll up again, and 8% is the market rate of interest. If we're paying it over 20 periods in 10 years, that's half of 8% each payment. So that's 4% is going to be that interest rate. And then what we would need to do is we would need to figure out from the present value tables the factor that we'll need to use. So they're asking us for what table value or present value factor will we use for the par value of $800,000. And which table factor will we use for the interest? Well, the par value is that one lump sum that has to be paid back at a future date. The interest is the periodic payments or an annuity. So we have to go look at the appropriate tables, and luckily they gave us links to the tables here. So we'll just take a look at each one. We're looking for present value of a lump sum for this one, present value of an annuity for this one. So let's just look at these tables real quick. Table B1 is the present value of $1. Now that sounds kind of like a lump sum to me. Table B2 is the future value of $1. That's not the present value at all, so we don't even need it. B3 is the present value of an annuity. That sounds familiar. And B4, once again, is the future value. We don't need future value. So it looks like we're going to be dealing with B1 and B3. And B1 is going to be that present value of a lump sum. So let's see if we can figure out what we're going to do with that one. Now again, remember the market rate is 8%. Semi-annually, that's 4. And we have 20 periods. So if we look at table B1 and we find 4% and we go all the way down here to 20 periods, so 4%, 20 periods intersects right here at 0.4564. So we're going to pop that into the equation, 0.4564. While we're at it, we might as well go ahead and look at the present value of the annuity due. So that's going to be on table B3. It's the same thing, 4%, 20 periods, and that's 13.5903. 13.5903. All right. So what are we going to do with these things? In both of these instances, we are going to be multiplying. That is going to be our operator because these are factors that we're using. And what amount? Well, this par value is on the lump sum due at a future date. That's $800,000. And then the interest, this factor is going to be multiplied by each periodic payment. Well, we did that in requirement 1 to 3. We calculated that each payment was going to be $24,000. So that's what we're looking for right here is $24,000. And now we have what should be the price of our bond at a discount. This $800,000 bond, because our contract rate is lower than the market, should sell for $691,287. So let's move on to requirement 5, and that is to prepare the journal entry to record this bond. So this is recording the issue of bonds with the par value of $800,000. The first question always for me is what do we get? And we're getting cash. And the cash that we're getting is what we were able to sell the bond for at $691,287. We know that we're going to have to sell this at a discount. So we have discount on bonds payable, and that is simply going to be the difference between the actual bond amount of $800,000 and the cash that we just paid. So we can certainly figure that out. It was $800,000 minus the got to get that out of the way, minus the $691,287, and we get a discount of $108,713. And obviously we now have a bonds payable of $800,000. Okay, so just to recap, we calculated what our semi-annual interest payment would be, what the number of payments were, and the fact that we were selling at a discount. We calculated the price that we should sell this bond for by using our present value tables, and then we recorded the issuance of the bond. Okay. And I figured it would probably make me do this, so let me get this straight again. Okay, so I got logged back in. Hopefully we will be okay now. So on to number 2. I had hit the next button past that first problem. On to number 2, and we're dealing with an installment note. Remember now that installment notes are a little bit different from bonds. Bonds, we pay back the amount that we borrowed. Remember, bonds are basically debt. We pay back the amount that we borrowed at one lump sum when we're dealing with a bond at some future date, and we just pay interest over time. But in an installment note, which works which is how your mortgage and your auto loans work, or if you're going to go and borrow money from the bank, you're going to pay principal and interest back with each payment that you make. So we have to calculate that interest with each period. Let's look at the problem here. On January 1, 2017, Eagle borrows $100,000 cash by signing a 4-year 7% installment note. The note requires 4 equal payments of $29,523, consisting of accrued interest and principal on December 31 of each year from 2017 through 2020. And it's telling us to use appropriate factors from the tables provided to figure things out. And really, the only time you would need to figure this out would be to try to calculate this payment, to figure out what payment should be made in order to do that. They've already given us the payment amount, so we certainly wouldn't need to. However, if we did, all we would need to do is look for the factor that would help us calculate this payment for $29,523. Well, how would we do that? Well, it's a 4-year note, it's 7% installment, and you have to ask yourself the question, what is this? Is it a lump sum or an annuity? And it's absolutely an annuity because it's going to be equal periodic payments. That's on table B3. So looking for 7% and 4 years, 7% and 4 years is this factor of 3.3872. When we're trying to find the payment, we take the amount of our note, 100,000, and we're going to divide it by that factor, which was 3.3872, and it should always return what the payment should be on an installment note. And there it is, $29,523 rounded. When we're dealing with an installment note, we're always going to be computing our interest expense based on the prior year ending balance, which obviously would be the same as the current period beginning. So we're starting 2017 with a $100,000 beginning balance, and now it's asking what should the interest expense be on this? Well, I'll do it just for example, but 100,000 times 0.07 should be $7,000. $7,000 is our interest expense, and then it's asking what should we debit out to notes payable. Well, I think it's easier to put this in first. How much are we going to credit to cash? That's going to be this payment of $29,523. Well, if I'm paying out $29,523 in cash and $7,000 of that amount was interest, then the difference has to be what I'm bringing the balance of the note down by. So I'm going to reduce the balance of the note by $22,523. Simply, this field is whatever we're paying minus the interest expense. So $29,523 minus $7,000, and that should now leave us an ending balance, $100,000 minus $22,523. So let's clear this out. And 100,000 minus 22,523 gives us a balance of 77,477. That means our beginning balance next period is also 77,477. And once again, I need to calculate interest, so I'm just going to go ahead and multiply by 0.07 here. Our interest expense should be $54.23. If I'm going to pay out cash of $29,523, I pay the same thing every period. Then I'm going to take $29,523 minus the $54.23, and that's going to give me a debit to notes payable of $24,100. So now I'm going to take my ending balance, $77,477, minus the debit to notes payable, $24,100, and that gives me $53,377. And we keep running that through the same way. My beginning balance times 0.07 gives me an interest expense of $37.36. I'm going to pay $29,523 take 29,523 minus that 3736 gives me 25,787, and I'm going to basically just take that away from 53377 is going to leave me 27,590, and we'll finish this out by finding the interest on that. So 1933 really is going to round it out, is what I'm in the wrong field, sorry. 1933, they're gonna force this in. The payment is 29,523. So what it's doing is it's automatically calculating what the final debit to notes payable and the debit interest expense. When we calculated 1931, but because of rounding through here, it needed 1933 to bring it down to a zero balance. And that's how installment notes work. All right, so we'll go on to our last problem, and we've moved into chapter 11 at this point, talking about the corporate form of organization and some of the transactions that happen here. Remember, in the corporate form of organization, we're dealing with stock issuances. Sometimes we can have stock splits. We can declare dividends to our shareholders, and we can buy our own stock back off of the open market, which is called treasury stock. So we're going to deal with a little bit of most of those things, at least in this problem. So we're talking about Alexander Corporation, and they are reporting the following components of stockholders' equity. And we'll see here that this is the partial balance sheet. So they have the common stock at $25 par value. 50,000 shares are authorized, but they only have 30,000 out there. That's what calculates out to 750,000. They've got some paid-in capital in excess on common stock, and then they have retained earnings here as well. So they're asking us to take these transactions and get them recorded in a journal entry. So we've got to prepare a few journal entries here. And this first one is to record the purchase of 3,000 shares of its own common stock for $25 cash per share. Well, that's treasury stock. Anytime we're going to go out and buy our own stock off the open market, we're talking about treasury stock. And we always bring treasury stock back on the books at what we paid for it. We ignore any thoughts or concepts of par value, and we bring it on at exactly what we paid for it. And we paid, in this case, $75,000 in cash by taking 3,000 times 25. So we'll record that entry. And now we want to record the declaration of a cash dividend of $1.50 per share. We can see that right here. Directors declared $1.50 per share cash dividend payable on February 28th to the February 9th stockholders of record. All right, so let's see if we can figure that out. You'll see that there are 30,000 shares issued and outstanding. So I think normally we would want to go ahead and just take 30,000 shares times 1.5 and come out to a total of 45,000. That's where you're going to want to go, but don't do it. Remember that in this example, we bought back 3,000 of our own shares. We're not going to pay a dividend back to ourselves, so we really don't have 30,000 shares to pay on. We have 30,000 minus 3,000 shares. So we have 27,000 shares at $25 a share, and that just didn't work at all, did it? So 27,000 didn't do it all the way right. 27,000 times $1.50 was the dividend. Sorry, I needed to move over to this one. That $1.50 per share, and that's going to be the dividend. Remember that dividends come right out of retained earnings. So 40,500, and this is the declaration. So on this date we owe it. We haven't paid it on this date. This is the date of declaration. So we now have a payable, and we call that common dividend payable. All right. Moving on, we record the payment of the cash dividend. So we're going to pay this transaction off. Well, I have to relieve that payable, so common dividend payable goes down by 40,500, and we pay cash of 40,500. All right. Now we're going to reissue 1,200 shares of that treasury stock. So I'm just going to flip back to number one. We purchased 3,000 shares for 25, and now we're going to resell 1,200 shares for 30. Well, that was good for us. We made a little bit of money. So we can take 1,200 times 30, and we know that equals 36,000. That's the cash that we're going to receive on the sale, $36,000. We also know that we purchased that stock for $25 a share. So we have to take the treasury stock, if I spell it right, we have to take the treasury stock off the books at the $25 per share. So that's going to be $30,000. And then what do we have? We have something left over. Well, that's always going to be paid in capital. But in this case, it's going to be paid in capital in excess of treasury. Where is it? We're going to have to find it. There it is. Paid in capital on treasury stock, and that's going to give us an extra $6,000. Again, remember, we're selling for 30, but we had originally purchased it at 25, and that's why we needed to calculate this addition. We have to take it off the books at the same price that we paid for it. Okay, so now we're going to reissue 1,500 shares for $20. So we've lost money. We bought it for 25. Now we've lost money. So let's do the easy parts first. We know that we're receiving cash based at 1,500 times 20. So that's going to be $30,000. I'm going to go ahead and just skip a couple lines because we also know that we need to take the treasury stock off the books. Again, I have to be able to spell. It just doesn't want to pull it down. There we go. Let's do it that way. Where's the treasury stock? There it is. Treasury stock. We need to take that off the books. So that's going to be 1,500 at 25. So that's 37,500. So already we know that we need $7,500 to adjust the difference here. Well, we always are going to take that out of the paid in capital treasury stock if we have it. So let's get that. There it is. But how much can we take out of it? We can never take out more than we put in. We only put in 6,000, so we can only take out 6,000. To demonstrate that, it's here in number 4. We only put 6,000 in that account as a credit. Therefore, I can't take out more than 6,000 as a debit. And of course, now it's moved this up on me, so I'll have to change that here in a second. So what do we do with the remainder of this? Let me go put the treasury back in the right place. So what do we do? What is this number going to end up being? Obviously, we need 1,500. And the rules say that once you have taken all of that paid in capital out, you're going to have to eat the remaining loss and take it right out of retained earnings. Connect was being a little funny there. Sorry if that looked a little confusing, moving that treasury stock around. All right, so it looks like we are going to declare a cash dividend of $2 per share at this point. So once again, we're going to take that out of retained earnings. And the question becomes, how many shares are we going to declare this dividend on at this point? This is a $2 per share dividend. Well, I don't know how much treasury stock is still out there, right? So let's just go take a look at that real fast. Remember that we purchased 3,000, and I believe we sold back a few. So we sold back 1,200 and 1,500. So we're going to do minus the 1,200 minus 1,500. So there's still 300 shares in treasury, right? And if that's the case, then we're going to take 30,000 minus that 300 shares. We have 29,700 shares still on the still out there because we have 300 in our stockpile at $2 per share. So times 2 means that our dividend is going to be $59,400. And again, that's a payable. We haven't paid it yet, so common dividend payable, $59,400. We move on over to pay it. Again, we're going to relieve that payable, $59,400, and we're going to pay it in cash, $59,400. That one's nice and easy. We like those the best. And then finally, it says record the transfer of the credit balance of $52,000 in the income summary account to the retained earnings account. Even if we don't remember what's going on here, they kind of gave us everything that we needed just in what they've said here. Remember, income summary is that temporary account that we close all revenue and expenses to at the closing period, at the very, very end of the accounting cycle. This is the last transaction that we make before we do our post-closing trial balance. The income summary, therefore, contains all revenues and all expenses from the period. And then the last thing that you have to do is just take that balance out of income summary and put it into retained earnings. But even if you didn't remember all that, it says record the transfer of the credit balance of $52,000 in income summary out to the retained earnings account. Well, if it has a credit balance of $52,000 and I want it gone, that means I need to debit that account. So income summary gets a debit for $52,000. And if I'm going to move that into the retained earnings account, whether I knew it or not, I have to do it as a credit, and it's obviously going to go into retained earnings, $52,000. I don't want you to always have to try to just back into it based on what they're saying. It's good to understand that concept. So if you don't remember that, then maybe you should go back, take a look at Chapter 4, just to see what those closing entries look like. We'll go ahead and record that. And we're now required to. It says prepare a statement of retained earnings for the year ended. We just did a lot of things in retained earnings, so we're going to have to at least explain what those things are. Remember, retained earnings always starts with a beginning balance, so this is going to be retained earnings at December 31, 2016, and no matter what we do, it should end with retained earnings 2017, if I can make it come up. There it is. It's always going to end with that. And let's kind of think about what happens in the middle. Well, in the middle, we always added net income. And if you recall, we also took away any cash dividends that were declared. And then the other thing that happens now is that we also take away any losses on treasury stock issuances. Remember, we lost that $1,500. So we need to take into account that. So we have to figure out what was our retained earnings balance, and here it is. It was $340,000 up here in the chart. So $340,000, and our net income, we just closed net income summary to retained earnings, was $52,000. Now it's asking for how many cash dividends were declared. Well, we could go back and look through the journal entries. We'd need to go add them up. So here they are. We had a $40,500, and then we scroll on down here a little ways, and it looks like we had another one of $59,400. So $99,900 is what we're looking at. So we've got minus $99,900, and then again recall that we lost that $1,500 on that treasury stock reissue, and that gives us an ending retained earnings balance of $290,600. Okay. Finally, they want us to do a stockholders' equity section of the balance sheet, just the bottom portion of the balance sheet for December 31, 2017. The equity section for a corporation is always going to start with a common stock, unless there's preferred stockholders. I told you that preferred stockholders have preferential treatment, so they would normally get listed first. This corporation, Alexander Corporation, doesn't have any preferred stockholders. We have common stock at $25 par value. The next thing that we'll always want to put in the stockholders' equity section is going to be the paid-in capital in excess of par. We're going to go ahead and list our retained earnings. And then finally, we're going to list the cost of any treasury stock that we still have on our books. And we do still have 300 shares of treasury stock, so we'll need to look at that. So common stock, $25 par value. This should not change. We haven't issued any new shares of stock. We're still dealing with the original 30,000 shares issued and outstanding, so that's 750,000. Do we have paid in capital? We didn't change any of that either. There's the 50,000. So that brings in. What about retained earnings? Well, we just calculated retained earnings in requirement number 2, so I'm going to flip over there real quick. There it is, 290,600. And then we have the cost of treasury stock, which I believe was 300 shares, and we purchased it for $25 a share. So we need to take that out at 7,500. Okay, that completes groups chapters 10 and 11. Of course, you should always go through and check my work just to make sure you haven't missed any titles or anything. Remember, you have a few attempts to try to get those things corrected in this group. And of course, now that this is on YouTube, you have the ability to pause and rewind and try to figure out where we made a mistake. Anyone has any questions, please shoot me an email and we can discuss it further. Otherwise, hope you guys have a great rest of your day.